Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is Saturday. It is August the 19th. I took a little bit of time yesterday to put together a presentation for you to talk a little bit about building your own energy ETF. Now, I have spoken about ETFs before quite a few times. In fact, I own two ETFs. One of them is VYM, which is a market ETF, and the other one is XLE. XLE is actually one of my largest energy positions. But what I wanted to do today is kind of revisit some of the homework some of the people on the channel gave me to do, and then talk about some of these stocks and build a little basket of energy stocks, which is kind of like building your own little mini ETF, right? So Joe, our friend, said, Mr. Oxy, glad to see you again. Still out of the market right now, but I'm just curious, do you have any thoughts on gas, GASS? Thanks, Joe. Well, Joe, I didn't have any thoughts on gas, but I do have some thoughts now. I'm going to share them with you in just a minute. Steve said, did you ever do a deep dive on Kinder Morgan? So, Steve, the answer is yes, but it's actually a few years ago. I have a couple of sort of favorites, and I use that term loosely because we shouldn't have favorites, but my largest sort of Kinder Morgan type stock right now is Energy Transfer. And up until a couple of months ago, I had a very large position in Pembina Pipelines as well, which is the Canadian pipeline operator, but I exited that one in its entirety. I'm going to talk a little bit about that one too, because now that I'm out of the position, it's worth my while to take a little bit of time to look back at it and maybe either confirm my decision to exit the position or otherwise see if I should place it back on my watch list to perhaps open a position again. And then Steve continues and he says, picked up Devon a few months ago. And then he says, also glance at EPSN. So I was not familiar with EPSN really, never really looked at it. No debt, $40 million in cash. So Joe, thanks for highlighting gas, GASS. And Steve, thanks for reminding me that Kinder Morgan still exists and for telling me about EPSN. So we're going to take a look at those in just a minute. Just before I go into the video here that I want to make, sort of in the early 90s, I think it was 1993, when Vanguard launched the first ETF, which is an exchange-traded fund in the United States. Of course, it was new to us. We didn't really know what it was all about or how it would work. And I remember asking one of my colleagues once, maybe almost 10 years later or so, it was probably more in the early 2000s. I said, do you invest or have you ever looked at opening a position in any ETF? And he said, why would I buy an exchange traded fund when I can just copy what they do and build my own ETF at no cost? Now, for the people who've been following the channel, you know that I've been mentioning XLE for a long time. I said it's probably the easiest pickup, if you want to park some cash, if you have cash awaiting investment and you don't know where to put it, rather than having it sit in cash, which is effectively a declining asset value, rather put it into something like XLE, where you're investing in a strong sector, one that gets consumed and used every single day at a rate of about 100 million barrels of oil per day. And in addition to that, XLE has a low management fee, which is 0.1%. And it pays a dividend. So it's an easy sort of parking lot for cash awaiting investment. What's in ETF? So this particular one, so XLE, you can always look at the prospectus of the ETF, so the exchange traded fund, so that you can see what's in it. And this one's about 40% of the two majors, Exxon and Chevron, and then sort of 5% or thereabouts of a number of really, really great but smaller energy companies in the United States. Now, nothing prevents you from building your own ETF like this. And also, it's always a good idea to have an anchor or two, which is sort of a foundational stock if you want to build your own basket of stocks. You can take some chances on things like gas, GASS, and EPSN, which I'm going to talk about in a minute. But always make sure if you build your own little basket that you have a bit of a safety net there instead of just running a high risk, high return type scenario, hopefully, right? At the bottom, you can see that XLE has 26 holdings. You don't have to have that many. You can actually literally just copy the sort of top holdings. This is not even the top 10. This is the top 8. You could copy that, sort of basket of energy stocks for yourself and effectively just buy the stocks, and wherever you might be located in the world, you might pay no brokerage fee or a very small brokerage fee. And after that, you pay no cost. So it's kind of free. You just hold the stock. And because you have a little basket, you also mitigate single stock risk. Right at the bottom, you can see the top 10 holdings are 73% of the total assets, right? So you want to have good stuff in 50, 60, 70% of your basket. Maybe take a risk with some of the smaller percentage of your assets. So what are we going to talk about here? So I built a little basket, and at a glance, if I use the sort of Jim Cramer lightning round, no, not what's it called, where people tell him what their 5 stocks are, and then he says whether it's good or not. So if you look at this little basket that I built, you can automatically see there's a problem here because I have 2 companies that are oil production and pipeline, Kinder Morgan and Pembina. You don't want to have 2. You can pick one of these 2, or otherwise you can select a different pipeline company if you don't like either of these for whatever reason. These are all traded on US exchanges, so the New York Stock Exchange, the NASDAQ. And you can see that the other 3 are a little different, right? So I have a new one here. So thanks to Steve, we have Epsilon, Oil, US Integrated, and then I have Canadian Natural Resources. That's also a foundational type stock, and it's in a different country. So it's one of those examples where you could, for instance, say in my basket, I'm going to hold Exxon in the United States and Canadian Natural Resources in Canada. So I'm already diversifying my basket a little in terms of country, jurisdiction, and commodity price. One in US dollars, the other in Canadian dollars. And then the other new one here is GAS, GASS, introduced to us by Joe. So this is Stealth Gas, and this is a shipping company, transportation shipping company. I'm not really the biggest fan on shipping companies. Some years ago, I almost lost my shirt on Seadrill and managed to pull out of the deal with a break even. And I was very, very happy to do that. And I never bought another shipping company since. But anyway, many people have made lots of money in shipping, so they were much smarter than me. I did mention that you could have a different pipeline company, for instance, instead of having 2 like Kinder Morgan and Pembina. You can look in our library. There are a few videos that I made before, like for instance, Your Pipes versus My Energy Transfer. Energy Transfer is one of my larger holdings, and I compared it here to 4 different pipeline companies. And some of them are great, like Pioneer Natural Resources as well, or Energy Transfer, the gift that keeps on giving. So straight off the bat, I'll just tell you, in terms of my own portfolio, if I was going to build a basket of 5 stocks, instead of having Kinder Morgan and Pembina, I'd probably have Energy Transfer. But that's me. You got to do what's right for you. Let's go into the technicals here. And I'm not going to take too long on these because some of it is repetitive. So I'm kind of going to whiz through as best I can. The 20-day raw stochastic, if it's 80 or above, it's overbought. So Canadian Natural Resources is getting close to being overbought, even though the analysts are all saying buy, 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 buy. Conversely, Epsilon is completely oversold. So when it's less than 20 from a stochastic score point of view, as a general rule, it is oversold. Pembina is getting close to being oversold as well. And right now, ironically, everybody is saying sell, 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 sell on Pembina and buy, 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 buy on Canadian Natural Resources. So I have a bit of a mix here from an analyst point of view. One that I wouldn't invest in right away, simply because straight off the bat for me, firstly, I've already said that I hold Energy Transfer, but the Kinder Morgan price earnings ratio at 15.65 is a little bit too high for me here. I want it to be below 15. If it pulls back quite a bit from the current stock price of around $17.58, then I'd be more interested in Kinder Morgan than today. So that to me is a disqualifier. And a minute ago, I told you I had already exited my position on Pembina. So I'm going to just revisit it again briefly and sort of see what's going on there. These 2 guys, Epsilon and Stealth Gas, are new to me. So we're going to spend a little bit more time there looking at their fundamentals, but I won't keep you too long. And Canadian Natural Resources with an earnings per share ratio, a price earnings ratio of 10 is arguably a buy at 10. How about the performance? So over the past couple of months or so, if you were long in GAS, GASS, Stealth Gas, you are probably a happy camper right now. Over the past 3 months, you're up 80%. Over the past 6 months, you're up 92%. And the outlier here, the other outlier is Canadian Natural Resources, which over the last 6 months or so is actually green, plus 10%, whereas everything else is red. So as I said, this is a foundational one. So if I was building a basket, I would, based on what I'm sharing with you right now, maybe eject Kinder Morgan and Pembina and insert something like Energy Transfer or Pioneer Natural Resources or something like that instead. I would maybe go with a second foundational stock like Exxon. I prefer Exxon to Chevron for a variety of different reasons, and maybe plug in another sort of foundational stock like Canadian Natural Resources, and then start using some play money for things like Epsilon or Stealth Gas. About the per share information. So what we have here is all positive earnings. They've all already reported their earnings. There are a couple of them that have ex-dividend dates coming up in September, so you may want to look at those if you're interested. And then what's interesting here on a key statistics point of view is the market cap of the company versus the annual sales. And what I'm looking at here specifically is Kinder Morgan has a market cap of around 38 billion and annual sales of about 19 billion. So it's easy math, right? 19 times 2 is 38. And if we look at Pembina, it's sort of similar. 9 times 2 is 18, right? So that's 16 there. I'm looking for outliers. I'm looking for things that are a little bit weird or different, right? So here's my first one. So Epsilon has almost $70 billion $70 million in sales and a market cap of only 116 million. So there's a much smaller delta there between the sales revenue that the company is driving and its market cap. Canadian Natural Resources, as I said, more foundational, very more sort of normal again. 32 times 2 is, 64. So it's all there or thereabouts. But look at this one. Here we have Stealth Gas, which was Joe's pick, $150 million in sales with a market cap of only 194 million. So based on some of these fundamentals and benchmarks and ratios that I'm sharing with you, these two guys actually look like they potentially are buys. Now, I wouldn't be as bold as to just jump in, but I could certainly add them to my watch list, right? And sort of keep track of them over the next couple of months or so, see where they're going. How about over the last year? As I said a few minutes ago, if you were long in Stealth Gas, you're a happy camper, but because you did really, really well. The other 4 of them are kind of bunched or grouped together here. The only exception is that Canadian Natural Resources actually delivered a positive return over the last year, while all the others were negative, and some of them, like Epsilon, actually quite badly so, negative almost 30%, right? So we can look at some of these metrics and benchmarks. I like to look at a period of about a year or longer rather than a short period of time. So very quickly, let's look at the sort of snapshots of the company. So in the first place, I have Kinder Morgan here. You can buy it at $17.45. It's a mid-cap value stock. It's got a market cap of around $40 billion. It's sitting sort of in the center of its 52-week range. Could go either way. I'm not sure. Nobody knows. Positive earnings. The PE ratio a little bit high. I want it to be below 15 because that's where the S&P 500 is right now. So I want to buy in at a cheaper price earnings ratio than that, preferably 10 or even below. Over the past 1 year, so all these graphs are 1 year, it's underperformed the major indices quite significantly. That's the Dow Jones, the S&P 500, and the NASDAQ. So if you were just in a general ETF like VYM or SPY, you probably would have outperformed Kinder Morgan. How about Pembina? Same thing, right? The graph looks the same. This is a large cap blend from a Canadian point of view. You can buy it for $30. It's a $17 billion company. Also positive earnings, much more attractive PE than Kinder Morgan at only 8 versus Kinder Morgan's 15. It's sitting way to the left of its 52-week range. Now, remember, I said a few months ago, I sold out of Pembina. I actually sold out of Pembina at $36 per share. And right now, you can buy into Pembina at around $30. So, this is possibly something where I'll add the stock again to my watch list and sort of see where it's going and see how it trends and decide if this is something that I want to get back into or not for now. I was in Pembina, by the way, for close to 10 years. So it's not like I'm not familiar with the company. How about Epsilon? This is a $5 buy, right? So it's sort of borderline penny stock. If a stock is trading at $5 or less, it's generally regarded as a penny stock. A small cap blend, $118 million in market cap. Market cap, in case you can't remember, is the total number of shares outstanding multiplied by the share price. So 22.2 million times $5.34 when I took the snapshot. That's where you get the 118 million from. Sitting way left as well on the 52-week range. So it could be a potential buy here. Look at this very nice juicy dividend, right? Almost 5%. It's paying an annual dividend yield of 25 cents on a $5 stock. Grossly underperformed the indices. So once again, if you don't like single stock risk, you could have just bought VYM or SPY or something like that, and your performance would have been up here instead of down there, right? So that's Epsilon. But let's take a closer look at Epsilon, because I don't know the company, or maybe you don't either. From a valuation point of view, it seems fairly valued with its PE of 5.31. Arguably, I would differ there and say with a PE ratio of 5.3, it's actually quite cheap. It's not really in line. The industry is at around 8, and Epsilon is at around 5.3, and that's on a trailing 12-month basis, TTM. So I like it here for that reason, but I wouldn't buy it. I'll put it on my watch list and keep track of it maybe for a few weeks, a couple of months or so, to see where it's going. Even its price to book, it's attractively priced in terms of those particular ratios, which we always look at. From a profitability point of view, it converts a larger percentage of its revenue to profits. This is a pretty good picture for the trailing 12 months of gross profit, almost double the industry. And right at the bottom here, the net profit margin, more than double the industry's 18%, with times 2 would be 36, and Epsilon's trading at almost 44% net profit margin over a trailing 12-month period. That's a good picture. Pays a dividend, as I said, of 25 cents. It's currently yielding about 5%, so it's sort of in line with the industry average. It saw an earnings decline over the last 12 months, although it was at a slower rate in the decline in revenues, but it was able to improve its earnings result during that same period. These numbers do not look very good at all from a growth rate point of view. I want to see numbers that look a lot better than this. The earnings per share growth over the trailing 12 months was negative more than 9%, and the industry 64%. That's a huge difference, right? So the industry, coming back to my comment about XLE, you could have just bought XLE, you would have been better off. And right at the bottom, the revenue growth, this is not a good picture. The industry is growing revenue at about 12% on a trailing 12-month basis, and Epsilon is lagging with negative 13. From an effectiveness point of view, not too bad. It's sort of in line with its peers. And you can see the numbers are pretty similar, except for the return on equity, which is pretty good. Return on investment, 20 versus 20 for the industry. Not too much to see there. And then this is a good slide for me here. Epsilon has little or no debt, and thus little financial risk. Now, the good part of this particular slide that I'm sharing here with you is that companies that don't have a lot of debt very seldom go out of business. So from that point of view, this is a company that is financially sustainable as it is right now. So the total debt to capital ratio is pretty much near zero. When I see numbers like this for the quick ratio, so the quick ratio is how much cash do you have compared to how much accounts do you have payable in the next 30 days or so. There's no number there, so I need to do a little deeper dive into the balance sheet to see what that looks like. That's the quick ratio. The current ratio is all your current assets and equivalents. So accounts receivable and things like that compared to your short-term payments that are due. So quick ratio is cash, and current ratio is cash and cash equivalents. And then the interest coverage is also just ... So I need to do a little deeper dive. I'm just going to share this last slide with you here before I move on. From a balance sheet point of view, the cash and short-term investments look good. The total equity took a little bit of a dip here in 2020. I think we can all remember the pandemic, but then that's been trending upwards. That's a good picture. But here's what I was looking for, right? So the cash and short-term investments, 45 million, and right at the bottom, accounts payable, 1.6. Right, so that's a very comfortable quick ratio, current ratio. But from that point of view, this company is solid financially. And as Steve said when he introduced us to the company, no debt and 40 million cash in the bank. Let's move on. So this is a foundational one. So just very quickly here, Canadian Natural Resources is a large cap blend. You can buy it for $60. It's a $67 billion company. All the numbers are good PE, under 15, it's 12. Maybe if it pulls back a little, I want to buy it, but this would be a foundational stock for me, an easy add to an ETF basket. The only thing is here also, much like the PE ratio at 12, the 52-week range is sitting way to the right. So maybe we want to see it pull back sort of under 60. And who knows, if you're lucky and they have a bad quarter or something like that, maybe you can pick it up for like $55 a share. That would be a good deal. How about Stealth Gas? So I need to look at this one because Joe introduced us to this one and I didn't know it. So this one easily outperformed the indices. So a nice performance here over the past 1 year. That's the period I'm looking at. It's a small cap value based in Greece, like many shipping companies are. It's a $187 million company. It's got positive numbers. It's got a low PE ratio, 4.5. It's sitting just right of center on its 52-week range. So it's trading now at $5. It's low over the past year has been $2.50 and it's high around $6. So it might be a little bit of run rate there. Would I buy it? No, I would not. But would I add it to my watch list? You bet. And then if I do that, I can track the stock and see where it goes and what it does. It seems inexpensive with the PE value. I'm just going to go into the same valuation analysis as what I did a minute ago for Epsilon very briefly. Inexpensive, the PE value of 4.47. The price to book as well, 0.37. This is a good picture. From a profitability point of view, pretty good as well. The gross profit margin is in line with the industry, but the net profit margin is well above, more than 10%, or about 10% more than the industry average or compared to its peers. The earnings trend has been positive over the past 12 months. The company has reversed the prior loss that it had on the books. The earnings per share growth over the past trailing 12 months, 253%. Awesome performance, as with some of the other shipping companies as well. But here we're looking specifically at Stealth Gas. Revenue growth as well. Interesting. It's, not a bad picture at all. From an effectiveness point of view, it's doing a very poor job in comparison to its peers. In fact, very, very poor indeed. From a return on investment point of view, 5.7% compared to the industry's 21%. And from a return on equity point of view, only 8.5 compared to the industry's 42. This is not a good picture at all. From a financial strength point of view, not bad. Even though it has a debt to capital ratio of 31.56, this is not unusual in shipping companies. Ships are expensive. A current large tanker runs over $1 billion or thereabouts. Total debt to capital ratio is in line with the industry and its peers. The quick ratio is solid. 1.68, you want it to be 1 or above. So if it's 1.68, it's comfortably above 1. The quick ratio means it has 1.6 times more cash than what it has accounts payable within the next few months or so. The other thing to keep in mind, if you're going to build a little basket of energy stocks for yourself, you also need to be aware of the fact that even though I'm an energy bull and I've been doing lots and lots of energy videos and I talk a lot about energy, if you look at it over a 5-year period, and you look at energy specifically, these are the 5 companies up here, this graph over here. You can see some of them have done better than some of the others. The top performers have been Epsilon and Canadian Natural Resources. And the outlier here was Stealth Gas that just suddenly spiked over the past year or so. So Stealth Gas has actually sort of been an outlier here because of this phenomenal performance over the past few months or so. However, what I'm saying is this. Just because I'm an energy bull and I'm making energy videos, it doesn't mean that energy is always going to be a winner, right? If we look at the sector performance versus the S&P 500 over the last 5 years, coming back to where I started, if you had purchased an ETF like SPY or VYM, for example, you would have been up about sort of 50-ish%, right? So the S&P 500 as a complete sector, the entire sector, which is what SPY invests in if you want to buy that ETF, returned a performance of approximately 50% over the last 5 years. So on the far right here, right at the bottom, you can see energy, right? So it's lagging quite considerably if you take into consideration that if you had invested in energy 5 years ago and went through all the ups and downs of energy, including the pandemic and then the bounce we had after that, where WTI went right up to $130 a barrel and then all the way back down again to like $60. If you had just stayed in energy, you would have lagged in the S&P 500 as an index considerably, right? And of course, if you got lucky and you said, I'm going to time this well, and when you got out of energy, you got into information technology, and then you got out of information technology at the right time and got back into energy, nobody can do that, right? But you can see the performance here over the past 5 years. So don't get locked and loaded. And don't get into a mindset of ready, fire, aim, right? You want to be the other way around. You want to be sort of ready, aim, and then fire, right? No one can predict where the sector is going and what it's going to do, but certainly you want to make sure that you don't put all your eggs in one basket, which is one of the reasons why I'm talking about a diversified energy ETF, even if you build it yourself or buy XLE, or otherwise just diversify your stocks a little bit to mitigate risk for yourself. I'm going to leave you with this one. The Joker Speaks made this comment, and he was commenting on tip ranks, because very frequently when I make these videos for you, I also go to tip ranks, and then I always say analyst, schmanalist, right? So most of the time they get it wrong. Sometimes they get it right. I don't even know how you get a job like that. It's almost like telling you what the weather is going to be tomorrow, right? If it's not cloudy, the sun's going to shine, and if it doesn't rain, then it's going to be sunny. It's like whatever. They get it wrong all the time, and if they get their predictions wrong, they just change their predictions. So the Joker Speak says, I signed up for a free trial on TipRanks. I also have a free trial on TipRanks. The Joker Speaks. I will not pay for TipRanks. Half the analysts were close to 50% in their predictions. There were just as many wrong 70% of the time. It's like analyst, right? But right at the bottom, he says, I may buy Devon if it pulls back a little. And the reason why I thought I'd leave you with this one is pulls back a little to what price? The Joker Speaks. So maybe you can let us know. Friday, this was year to date. Devon was trading at around $50 per share. And year to date, of course, it looks terrible. And this little grid on the left-hand corner here shows you some very, very large insider buys, right? 20,000 shares at $50, 75, $50, 5,000 at $53, 10,000 at $53. So my question to you, the Joker Speaks, is the insiders think that 50-ish is a good price to get in. So how much would you like to pull it, Devon, to pull back to before you pull the trigger? And maybe you can let us know in the comments. That'd be fun. Anyway, that's kind of a wrap on this one. So I think if you want to build yourself a little ETF, a couple of foundational stocks, maybe an Exxon, Chevron is a possibility. One or two of those majors. Canadian Natural Resources would be a foundational stock. Maybe you throw a pipeline in there if you can add a master limited partnership or a limited partnership into the mix. I'm not sure. Not many people can, or not everybody can. There's some tax implications, and there's taxation implications tax filing implications and tax withholding implications. So it's different for different people in different jurisdictions, right? But you could do a pipeline. It doesn't have to be a limited partnership. So that's a couple of foundational large caps, maybe a pipeline or something like that. Then you can get sort of a tanker in there, stealth gas or one of those, so mix it up a little bit, build your own ETF if you want to. Otherwise, if you want to go the low risk option or route, pay the 0.1% management fee and buy XLE. But at the same time, also don't ignore the fact that we're not 100% energy, right? And maybe look to diversify as well into some other sectors, or otherwise also just buy a little bit of SPY or VYM or something like that with your cash awaiting investments. There's nothing wrong in holding ETFs. They mitigate single stock risk, and over time, their performance is pretty much the same as the sector that you're invested into. So that's it, guys. I hope it's useful and educational for some people. Have fun. I'll talk to you soon. Bye-bye.